Key person life insurance is insurance owned by a business to protect itself against the financial loss of the sudden death of a key employee. Key person life insurance, the business is the owner and the beneficiary of the life insurance policy. Well, it's purchased by companies who would incur a financial loss in the event of their top people. Some examples you might relate to would be, for example, Warren Buffett to Berkshire Hathaway. Or let's say you're a sports agency and you happen to represent Tiger Woods or LeBron James. If they were to die suddenly, that would dramatically impact the revenues of that company. I mean, that might be the owner of the company, a person who guarantees the loans, could be a top salesperson, a significant stockholder. Could be any number of those factors that would go into who you would insure or a business might insure for key person insurance. When determining the amount of the policy, there are several factors that would come into play and it depend on the particular circumstance. But for example, if the individual owned a fair amount of stock and there was a contractual agreement for the company to purchase that stock in the event of that person's death, the company may want to purchase life insurance, the amount of the stock they have to repurchase. The cost to hire and replace a person. An example might be if there was a surgery center and there was a heart surgeon, and that heart surgeon was nationally renowned, and if she were to suddenly die, they would have to go out and replace that person. It could cost them millions of dollars of revenue, and so they may purchase life insurance on her life to recoup some of that profit and to find and attract a new replacement. On smaller businesses, it's not unusual for the owner to have to personally guarantee the debts of the company. And if you would look at the loan covenants of that lender, the loan is oftentimes due within 90 to 180 days of the date of death. So, for example, if an individual owed the bank, let's say, $500,000, or the business owed that and it was personally guaranteed by the founder, then the business would have to come up with $500,000. And so they would insure the person for that amount of coverage. Sometimes there's a key person, a key salesperson, and customers would be lost. So despite how good the business feels it is, the people are really loyal to that individual salesperson. If that salesperson were to suddenly die, then those customers might leave for competitors. And so the company might buy life insurance to replace the profits lost by the loss of those customers. And finally, a client of mine, for example, is a family-owned business, very successful, but no one outside the family is ever going to own stock. So to attract and retain the key executives, they have to pay these people a significant amount of deferred compensation. Well, if one of them were to die, the company, that amount is vested, and the company would have to pay the survivors the amount of deferred compensation. So they would purchase life insurance in that amount. So as you can see, there's a number of factors that would come into play depending on the circumstances of exactly how much life insurance you might buy for a key person. The type of insurance used for key person insurance depends on the length that the company needs the insurance and the company's ability to pay for it. Two types would be either cash value insurance or term insurance. Cash value insurance might be used if the obligation continues, let's just say in my example of deferred compensation, when that person got to retirement age and didn't die, the company still owes that person deferred compensation. So they might use cash value life insurance to accrue a fund of money to pay the deferred compensation. Alternative, if a business wanted to insure a person's life just for a period of time, say 10 years or 15 years, they'd use term insurance. I would have to say most often term insurance is used primarily because of cash flow considerations of the business. Well, to purchase key person life insurance is a little bit different than purchasing just personal insurance. Of course, you still need to pass the physical, and there will be a medical underwriting. They'll ask about your health and make you go through a normal medical exam. But there's also financial underwriting, and that is the company needs to justify that there would be a financial loss in the event of the death of the key person. And then the third thing would be like avocations. And that's true with personal insurance also, but oftentimes executives tend to do hazardous occupations such as motorcycle racing, hang gliding, parachuting, private piloting of small planes, those type of things. So those are all factors that would go into whether a person can purchase key person insurance. There are tax implications of key person life insurance. The premiums must be paid with after-tax dollars. The death proceeds are received income tax-free by the business, and if it's cash value life insurance, the cash values accumulate tax-free within the business. All business entities are eligible to purchase key person insurance. It really doesn't make a difference whether it's a sole proprietorship, partnership, C corporation, subchapter S corporation, limited liability company, family limited partnership. The entity simply needs to convince the insurance company that there's a legitimate financial need for the life insurance. It's a good idea to consult with your company advisors before the purchase of key person life insurance. The attorney's role, if you choose to use one, would be to draft a corporate resolution authorizing the purchase of the insurance, and by helping you create corporate minutes to document what actually occurred. Now, not every business does that, of course, but we do think it's a good idea to consult with your advisors before such a purchase. There are reporting requirements for key person life insurance. I would characterize them as notice and consent requirements. The employee must be notified that the employer wishes to purchase life insurance on his life and the amount of life insurance to be purchased. The employee in return must consent in writing to have insurance purchased on his life. Failure to comply with these rules can result in severe consequences in that the death benefit be treated not tax-free anymore, but subject completely to ordinary income tax. When dealing with key person life insurance, it is important to work with professional advisors both from a tax and insurance standpoint to best serve the needs of all parties.